Welcome to Talk Tickers. We dive deep into earnings calls to pull out the insights you need.
Today it's BuildDirect. We're looking at their Q4 and full year 2024 call.
Yep. We'll pull apart the numbers, look at their strategy, and figure out what it all means for the company.
Okay, so starting with the big picture for 2024, revenue came in around $65.5 million.
And the margin.
Gross margin was 38.7%. And adjusted EBITDA landed at $2.2 million for the year.
Got it. How about the last quarter, Q4 specifically?
Right, Q4 2024 revenue was $16.7 million. Just a touchdown from $16.9 million a year before.
Okay, pretty flat year over year for the quarter.
Yeah, but interestingly, gross profit actually went up, hit $6.6 million.
So the margin improved.
It did. 39.2% gross margin in Q4, up quite a bit from 35.2% in Q4 23.
That's a decent jump.
And adjusted EBITDA for the quarter.
Yeah.
Well, that saw a really big increase, $376,000 compared to just $73,000 a year ago.
Okay, 376K versus 73K. That's definitely noteworthy. So let's unpack that a bit. How did the different parts of the business perform?
Sure. So e-commerce, that's BuildDirect.com. Q4 revenue there was actually up almost 11%, hitting $4.2 million.
What drove that?
Well, they mentioned making some strategic inventory investments and focusing more on their higher margin direct source products. That seems to be paying off.
Right. But wait, didn't you say overall revenue was down slightly for the year? How does that square with the e-com growth in Q4?
Good point. So while Q4 e-commerce was strong, the full year e-commerce revenue was down 23%.
Oh, okay. Why? Big drop for the year.
It sounds like it was, well, a deliberate move. They purposefully scaled back that part of the business.
To do what?
To replatform, basically overhaul their online tech and really sharpen their focus, concentrate on the products and the regions that bring in better margins.
Okay, so pulling back to rebuild stronger makes sense. What about the other side, the retailer segment, their pro centers?
That segment saw a bit of a dip in Q4. Revenue down 4.6% to $12.5 million.
And
they pointed to general softness in the market, home remodeling, new construction. That whole area was a bit weaker.
For the full year for the pro centers.
Also down slightly. Full year revenue dropped 4.3%.
So e-commerce finding its footing with higher margins after a pullback, and the pro centers feeling some market headwinds. Let's talk profitability then. You mentioned the gross margin jump in Q4.
Exactly. And even for the full year, despite revenue being down overall, the gross margin actually ticked up slightly.
Which tells us what?
It suggests they're managing their pricing better or getting a better mix of products sold. Maybe both.
And that e-commerce margin specifically?
Yeah, that was really strong in Q4, jumped to 52.1%.
Wow, 52%.
Yeah, it really shows that shift to direct source, higher value products is working. At least on the margin front, for you listening, that kind of margin expansion is definitely something to watch.
Absolutely. Higher margins can really fuel future growth. What about the other side of the equation, expenses? Did they keep costs in check?
Well, in Q4, operating expenses were up slightly. Higher selling and marketing costs, some admin, R&D.
Okay.
But looking at the full year, OpEx actually decreased by 8%.
8% down for the year. How'd they manage that?
Primarily through cutting fulfillment costs, it seems, and just general operational streamlining, making things run leaner.
And they're not stopping there, right?
No, exactly. They announced more cost cuts back in March, just recently. Expected to save about $600,000 this year, 2025.
And going forward?
That should annualize to around $900,000 in ongoing savings every year. So definitely a focus on efficiency.
It sounds like it. Okay, let's shift gears to expansion. BuildDirect talks a lot about growing their footprint. What's their strategy?
It's pretty methodical, actually. They call it start digital, validate demand, then expand physically. Basically, using their online presence to test the waters before building out.
For the pro centers?
Yes, for the pro center network. And they do it two ways. One is building new centers themselves in key cities. They mentioned LA, Dallas, Atlanta.
Major markets.
Right. The other way is through acquisitions. Buying existing BDB flooring retailers, ones that already focus on the pro market.
And how do they approach those acquisitions?
They stressed capital efficiency, trying to focus on buying inventory, minimizing goodwill. The idea is to then plug these acquisitions into their system and get synergies, especially in purchasing and marketing.
Have we seen this in action recently?
We have. They just bought the flooring assets from Encore in Yorkshire down in Orlando, paid about $593,000.
Okay.
And they highlighted that was roughly 1 times EBITDA, so it seems like a potentially good price.
Right.
They also just opened a brand new pro center out in California, Santa Fe Springs, designed as a regional hub, apparently.
So Building and buying, actively executing that plan. With all this going on, how's their financial health looking overall, say, at the end of 2024?
Pretty solid. Based on the numbers, working capital was $2.7 million, right in line with the year before. Cash on hand was $2.4 million.
Right.
And a key development, they secured a new credit facility. 9.5 million Canadian dollars revolving credit from Royal Bank.
That definitely adds flexibility, doesn't it?
Absolutely. Gives them more room to maneuver.
What about debt levels?
Debt at year end was about $11 million. But, and this is important, they emphasized a significant chunk of that is friendly debt.
Meaning
It's from insider lenders. And critically, it doesn't have ongoing cash interest or principal payments attached right now.
Oh, that's a very different kind of debt than typical bank loans. Less immediate pressure.
Exactly. Likely more flexible terms coming from people invested in the company's long-term success. It provides a cushion.
Okay. So looking forward into 2025, what's the main game plan?
It really seems to be disciplined expansion of those pro centers. That's priority one.
Right.
Alongside that, unlocking more operating leverage. They specifically mentioned procurement, buying better, and marketing synergies.
And optimizing the whole operation.
Yes. Optimizing operations for sustainable, profitable growth. Management sounded pretty confident about keeping adjusted EBITDA on a positive trend.
Supported by
Those cost cuts we talked about, the efficiencies they're finding, and of course, the contribution from that recent Orlando acquisition.
Now, there's always chatter about tariffs in this industry and M&A more broadly. What's BuildDirect's take on those?
On tariffs, they seem pretty unfazed. They believe their flexible supply chain, with different sourcing options and backups, means they won't be hurt competitively.
Okay, they feel insulated.
Yeah. And interestingly, on M&A, they think the current environment tariffs, plus maybe some economic pressure on smaller businesses, could actually speed up their deal pipeline.
So make it easier for them to acquire.
Potentially, yeah.
Yeah.
They see it possibly creating more opportunities for them to buy those smaller B2B players they're targeting.
Okay, that's an interesting perspective. So boiling it all down for listeners tracking this company, what are the key takeaways from this call?
Well, first, that gross margin improvement, especially in e-commerce, is a big signal. It suggests their strategy shift towards higher value products is actually working.
Definitely one to watch.
Second, a clear push into the B2B pro market via the pro centers, both building and buying. That's central to their growth story.
Right.
Third, the focus on cost management. Those announced savings show a commitment to boosting profitability and adjusted EBITDA.
So keep an eye on execution.
Exactly. Watch the pace of new pro center openings and how well they integrate the acquisitions they make. That'll show if they're executing effectively.
And the broader market context.
Management clearly sees a fragmented North American flooring market and seems poised to be a consolidator. They think there are opportunities there.
Okay, makes sense. Right, now for the part where we put on our imaginary hedge fund hats, this is not financial advice. Let's cook up a wild, but maybe plausible trade idea based on all this.
All right, let's brainstorm. How about this? You go long BuildDirect, ticker BILD on the TSXV.
Okay, long build, and the other side of the trade.
You pair it with a short position, but not just any short. A basket of, say, publicly traded home improvement retailers.
Which ones specifically?
The ones that are heavily exposed to the DIY, the do-it-yourself consumer. Retailers less focused on the professional contractor.
Interesting. Long the pro-focused player, short the DIY heavy players. What's the thinking there?
The rationale is, well, BuildDirect is making this very deliberate pivot towards the pro contractor with the pro centers and these targeted acquisitions.
Right.
That segment, the pro market, might be more stable, potentially higher margin than the DIY side, which can swing more with consumer confidence and, economic ups and downs.
So the pros have more consistent buying habits.
That's the theory. So the short position in the DIY retailers acts as a hedge against a general slowdown in consumer spending. And it tries to capture potential underperformance if the DIY market weakens relative to the pro market where BuildDirect is focusing.
And the recent acquisition fits this.
Yeah, that Orlando deal at roughly 1x EBITDA, it kind of reinforces that they're finding potentially good value B2B assets. So the trade basically bets on BuildDirect's focused strategy paying off in a niche market.
Okay, I can see the logic. It's definitely playing a specific angle. What are the big risks, though? What could go wrong with that trade?
Well, several things. Integration risk is always there. With acquisitions, can they actually merge these businesses smoothly and get the synergies?
True.
Also, maybe the pros don't adopt the new pro centers as quickly as hoped. Maybe adoption is slower than anticipated.
And market risk.
Yeah, absolutely. Any big unexpected downturn in housing or construction overall could obviously hit both segments, the pro and the DIY side, hurting both legs of the trade potentially.
Got it. Some definite risks to weigh. Okay, well, that brings us to the end of our deep dive into BuildDirect's Q4 and 2024 earnings.
We've tried to unpack the numbers, look at the strategy, the outlook, give you a clearer picture of what's going on.
We hope this was valuable. Remember, always do your own homework before making any investment decisions.
What stood out to you? Any questions still buzzing around? Let us know. Join the conversation.
Thanks for tuning in to Talk Tickers. Until the next earnings deep dive, keep those tickers talking.